Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. What is going on, people? 11 a.m. on the East Coast. On this Thursday, September 4th, the calendar has changed. The weather has changed. There's that sort of biting chill in the air, which I love. I know Elizabeth's familiar with this. By the way, that is Elizabeth Thomas on her phone right now, who, by the way, prior to this recording was eating Cool Ranch Doritos.
Yes,
which
I was.
just
Doxed her snacking guy.
It.
By the way,
of it.
when did you adopt this little Al Roker thing? You know what I mean? Like just getting all.
No, that's fine. I'm not a big Al Roker fan, by the way. The hat's got to go. Okay. I'm sorry. By the way, Amanda, hold on. Amanda, who does not want to be on video. That's the voice of Amanda Diaz. Hello,
You
Amanda.
told me too late. You guys gave me a heads up like 2 minutes ago.
Oh, you should always be prepared to be on camera.
True. Camera
ready, as we call that. But that is the voice of Amanda, who, as we mentioned yesterday, I think it was yesterday, is back and better than ever. By the way, Amanda is doing great. That's Elizabeth Thomas. That's Dan Nathan. I'm G Swizzle. I was in my parking
Just want
garage.
to draw your attention to this comment. Amanda Diaz, smart and beautiful. Guy A, not so much.
All right, hold on a second.
James is spot on. James is spot on.
We're gonna send him something. A market call T-shirt because that was epic. and let me tell you something. How many do we have more of those things, Bill? Do you know? All right, for the next 10 people, and it's got to be in order. You got to see it in the sky. The next 10 people who have something great to say about Amanda being back with us, you get a T-shirt. You got to
see it on the
Here's
screen.
The thing. You got to email Amanda at riskreversal.com.
Blow her ass up.
Yeah. All right.
Right. So before we get into the market, I mean, you brought up Al Roker.
I did.
I was in I lived at 1 Columbus Place. That's doxing myself. 59th and 9th. They just built these 2 high-rise buildings, 51 floors, and I was getting my car, and Al Roker walked in, and I said, this is the parking garage on 59th and 9th, and I said, just want to say, I'm a big fan of your work. He looked at me, and then he looked away. He didn't even say a word. I'm saying to myself, what a huge Johnson this small little man is. I shit bigger than him. But I digress.
Back then, he was not a small little man.
No, he was a large small man.
Okay, Liz, we're going to get to your note, guys.
Moving on. I like that.
I'm not going to do it right now out of the gate. But she's got a snarky little title. She's back, baby.
I love it. I love this, by the way.
And Mario did a great job with some of those titles, but not the use of puns and all that sort of stuff the way you do. Guy, should we just start with the all-important August jobs number?
I think we should start there.
I think when you've just gotten back, like on your leave, we just gotten the all-important July jobs number and the revisions there.
Yep.
And the stock market did not like what we saw there, despite the fact that it kind of cemented the fact, that we're going to have a 25 basis point rate cut at the September meeting. What's your take into this? Is it just too much about nothing here?
Well, I mean, if it comes in at expectations or slightly below, rate cut expectations don't change. Right. Mario and I looked at this a little bit yesterday because there were some comments out there. I believe it might have been Bostic. I could be wrong about that. Some Fed talker talked about this, about what the number needed to be in order to basically stay at a comfortable level of unemployment. So in order for the unemployment rate not to rise. So when the revisions came in last month, it brought the 3-month average of jobs added down to 35,000 per month. That was uncomfortable for the Fed. We then heard from Jerome Powell at Jackson Hole. We don't like what is happening. He called the labor market in a curious balance, but it was clear that their risks were focused on labor for this next cut. I think that's still the case. The replacement number, meaning the number at which the unemployment rate probably won't rise, is about 70 to 75,000 jobs added per month.
So it won't rise like to 4.3 from 4.2.
Right. It won't make the Fed uncomfortable that unemployment is going to be on the rise. So you need the average to be somewhere in that 70 to 75,000 range. We're below that right now, which is why the Fed is uncomfortable. So tomorrow, expectations for jobs added are 75,000. And that's amazing, right? That it's right at that number. In order to get above that average and be too hot, we would need jobs to come in at like 168,000. So they'd have to surprise a lot to the upside. So I think if we get a benign report here, it's right on expectations, maybe slightly hot, maybe slightly cool. Nothing really happens. rate expectations stay where they are. The thing to be, I guess, weary of is that we got ADP numbers today. I won't get into the nitty gritty of this, but there are differences in how ADP is calculated versus how NFP is calculated. ADP, many people think, is a little bit more accurate because it's not as affected by some of the immigration stuff. ADP came in cooler than expected, so could mean that jobs added here again are going to be cooler than expected.
Guy's got his hand up over there. Hi,
Yes,
Guy.
Well, school started, and when I was a young lad in school, when we used to prepare for the nuclear wars and hide under our desk, the teacher said to raise your hand if you wanted to say something. So since it is back to school, I'm raising my hand. And thank you for acknowledging me, Dan. Elizabeth, JOLTS, for the first time, I think 4 years, job openings are lower than I think people looking for jobs or something like that. So remember there used to be 2 jobs for every 1 person looking. Well, that pendulum has swung. How important is that?
Yeah. So JOLTS typically lead the overall labor market when we're thinking about if unemployment is going to rise. Now, it's still okay, right? You've got maybe 1 person unemployed for 1 job open. You are correct. When the labor market was super tight, we were worried about what was called wage price spiraling, right? Because there were not enough workers to fill the seats. So the wages were being risen in order to attract them. And that drives inflation. We're not worried about that anymore. Now we've got, this is, I think, part of what Powell was talking about, a labor market in curious balance. Basically, if we can hold it steady right now at this level, everything's fine. But the chances of it staying steady, pretty low. So now it's whether it's going to break down or break up, right? I doubt it's going to stay at this level very long. I think that you probably have more of a weakening in the labor market, not a strengthening, but there's room for it to weaken before the Fed gets really uncomfortable. I think the Fed gets uncomfortable closer to 5% unemployment. And that's why they talked about the balance of risks right now being more skewed toward labor. And that's where we're getting this rate cut expectation.
So, and Liz, we've been talking about a little bit over the course of the week. If there's any big sort of, number like revisions higher, if there's some like sort of really strong number that kind of is not in line with what we've seen over the last 6 months or something like that, that's the thing where I think you could have a lot of volatility as it relates to the stock market. You know what I mean? Up or down. I mean, like, not down, obviously, but like, that's the one thing. Guy, I wanted to, you just talked about when you were a young boy in school, and let's just say this was like the mid to late 60s when you were a young boy in school. I'm not saying any. Am I saying any? You were born in 1963.
No, I'm laughing because it's true. It sounds like 1,000 years ago, but it happens to be factually true.
The year that JFK was shot and killed, sadly, in November
22nd, if memory serves.
You were born on December 18th, 1963. But, other than, and this is probably a good guess, I'll bet the number 1 profession of like a 5-year-old boy in school, what they wanted to be in 1963 was probably an astronaut. Is that fair?
You're asking me?
Well, JFK gave all these booming speeches about doing things,
right, the moon and all that sort of stuff. Go to space, and I remember the speech.
Number 2 thing among young boys in school in the mid to late 60s was the second job that they probably wanted to have.
Second job they wanted was a firefighter.
All right. We did not discuss this.
Okay.
Tonight, Guy Adami is emceeing the FDNY's annual gala. The speaker or the honoree is Adina Friedman, who is the CEO and chairman of NASDAQ. And we're so honestly, Guy, I'm saying this to you. We're really proud of you. It's a super cool thing. I was there 2 years ago, and Hank Azaria was the MC. And I can't remember. Oh, they were honoring Steve Cohen of SAC and Mets fame. He was horrible. And I went up to Guy afterwards. Guy was sitting at an honorary table right up front. I was like, Guy, you could have like wiped the floor with that guy. Somebody got the memo, and Guy's doing that. It's pretty cool.
Awesome.
I did it last year. Last year was Harvey Schwartz. This year's Adina. It is. Look, I'm not serious many times, but I am serious about this. This is a huge honor. I mean, there'll be 1,500 people at this thing. A lot of the men and women of the FDNY and EMT will be there. And I'll say this tonight, we go to work, all of us go to work, and you don't even you take for granted that you're going to come home that night. But, these folks, the chance that them not coming home, it's not great, but it's there. And that sort of Damocles is above them every single day. And they choose to do that, knowing that they still choose the job. And it's an amazing group of people, and the culture they have and all the traditions they have are tremendous. So it is a fun night. But thank you for that. I didn't know, by the way, I didn't know.
I just, when you did the school thing, I feel like, do you agree that back in, you're from Wisconsin? I mean, everyone wanted to be a policeman or a fireman, probably, right? That sort of thing. But no, Guy is never better when he does this stuff. I know you guys enjoy him on Fast Money, and he's been doing it. If we get to January, Guy will be how many years? 19 years.
That's incredible.
But he's never better in the front of a big crowd, and he will be. I know you're gonna have a few little zingers, but you take this stuff very seriously. And
are you? So my question is, are you nervous? Like, so we all do television, right? Nerves don't happen as much as they probably used to for most of us. And at least for me, when I'm doing stuff that's a part of my day job, I don't get as nervous. But when I have to do some of this stuff that's special, or if I have to do something in front of my peers, not millions of people on TV, right? Or do something in front of my peers, then I'm nervous. It could be 50 of my peers and I'm nervous, or doing something special like this that's a little bit out of the wheelhouse. It changes.
You know what? I'll tell you why the answer to that question is yes, because I want to be extraordinarily respectful of, the people there and what they're trying to accomplish in terms of fundraising and the institution itself. And you don't want to make it about me. I think the mistake that, Hank Azaria tried to be a comedian. The year before it was Gayle King. I don't think she was, she was made it sort of about her. And it's really important just to make it about the evening. And to the extent that I was able to do that last year, I think is one of the reasons they asked me back this year. So it is pretty cool. And Adina's a great honoree. We had talked about after last year who should be the honoree. I said, you should think about Adina Friedman, and they'd selected her, and she's been all in. So they're hoping to raise north of $4 million. And, this money, I'm sorry to go down this rabbit hole, but, all the things that their salaries don't cover, this money goes towards that. So anywho, there you go. So it's a fun night.
Well, I'm proud of you, and I'm proud to
too.
call you a partner and a friend. And you do amazing work when you do these sorts of things. And this is one that really matters. We do all these things with our sponsors and everything. You speak with us, and you're like so natural up there on the stage. We had when we were that time at Moody's. That was a huge. It was you and me. That was like a huge audience. There was a big room, and you were like a pro. You were great.
Thank you.
I think the first time I met Elizabeth Thomas IRL, is that what the kids say?
Yeah, the kids say IRL.
It was at one of those events. We were the three of us were doing some event somewhere where we sat on stage. Remember this?
Yeah, I do.
Or no, neither one of you. Forget it. Don't just say yes and patronize me.
We Liz has got to get a smoothie when we're done here, and she got a meeting here, guys. So no, this is my bad. I started some of this crap. I promise you, we're gonna get into some really good shit. We have Liz's note. It's on yields. We're gonna get that in a second. I want to hit some stuff in the stock market here really quickly. We talked about this on Fast Money Guy last night. Let's do enterprise software first, and then I want to talk about recent IPOs, because I think the recent IPO thing is a really important topic. Okay. So Salesforce, and we talked about Adobe. There's a whole group of enterprise software stocks that have not been participating in this last year and a half of this rally. A lot of these very companies, whether it's Salesforce or Adobe, in 2023, when this kind of AI trade was just starting to make its way through, NVIDIA was obviously one of the first ones. Guy will tell you that May quarter that they reported in May 2023, the stock had this massive gap. And then it was like the hyperscalers, their big customers. And then, it just was kind of working its way through that. But there were probably 10 or 15 stocks at that point that really had a good narrative, whether you're a big cloud player, whether you had an ad tech business, that sort of thing. Okay. So generative AI was something that if you were an enterprise software company, especially one like Salesforce, you should have been able to really infuse this technology and get internal productivity better. And then what you were able to offer, it just hasn't been the case. Mm-hmm. So Salesforce reports last night. We know Benioff, the CEO, is a very promotional sort of guy. I think he's a smart CEO. I think he's a transparent CEO. I think he can get over exuberant at some points here and there or whatever. The guidance wasn't enough, and they weren't able to tell a story about Agent Force and the uptake there, by their customers. So you see a stock acting this way. You kind of pointed out last week, it was sitting on really important technical support. Yeah. It looked like a Head and Shoulders going back, make that a 5-year, and they're just not delivering. I mean, I would expect this thing to go through those prior lows, Guy.
235. So, again, I want to be clear. Last week, a couple weeks ago, I said you could be long Salesforce into earnings against 235, and I was looking pretty smart for a very short period of time. And then here we are. I think it actually traded down to 235 today. So typically trades about 8 million shares a day. Dan can tell you how much it's traded already. So here's the problem, and Dan sort of hit the nail on the head. They beat this quarter's EPS. So it was the second quarter they reported. They beat expectations by 13 cents, which was fine. The quarter was actually fine. To Dan's point, the full year guidance was basically tweaked a little bit higher. So they gave full year EPS guidance of 1133 to 1137. But the problem with that is, although they guided slightly higher, given the magnitude of the beat, they actually missing full year guidance by 8 cents. Like, I don't want to get mathy on you, but that's effectively what happened. So they basically guided down for the year based on the 13-cent beat for this quarter. I think that's what the market took its cues from, if that makes sense. So here we are. I don't think valuation is unreasonable. I don't think a $20 billion stock buyback is all that interesting. But I do think what's interesting is the fact that we traded down to 235 and for now at least held. Now, Dan's probably going to wind up being right. At some point, we're going to go through that level. I think that was also the May low, like shit through a goose. And maybe we see the October 2023 level, which, Dan, you probably have at about $1.95. But for the here and now, that 235 is your line in the sand.
I got no clue about that. I think you're to go through 235. You're going to 210. You know what I mean? Just there's no technical support. There might be valuation support. There's no real fundamental story support. Really quickly, Liz, because we want to get your take on software. Adobe. Okay, their report next week. This thing looks like unholy death from a technical perspective. It's got all the same characteristics from a fundamental standpoint that you're talking about. Here's one that last week I said to you, I thought I'd rather Adobe than Salesforce. But after what I see from Salesforce, the narrative, the guidance, and the stock's reaction, or at least investor reaction, I'm kind of hard pressed to say this is worth your time because it looks like at a dicey spot here. You go through this 340-ish level. I know it bounced off of it today. You're headed right back towards those lows from, I think that's late 24. So, or late 23, excuse me. Liz, thoughts on software? Because this was a sector that was supposed to start to participate, at least if you thought the generative AI trade was broadening out. So thoughts?
And I was on that bus. Well, so last year I had made a call for software over semiconductors and it worked for a while. This year stayed on the software train for different reasons, but similar to what you just said, it should have been the conduit that brought AI to life. It should have been the companies, the group of companies that then created profitability for the companies that were promising profitability, right? You have to somehow implement it. Software should be the implementation tool. I still think that that will be the case. And some of these software names, so I talk about IGV when I talk about software, and you compare IGV to something like SMH for a cyclical signal. But when we're looking at tech overall right now, breaking it down into industry groups, if there's steam coming out of the engine in the SMH and people don't want to get out of tech, I do think software can be a beneficiary of that writ large. You're obviously talking about some idiosyncratic issues with certain stocks. If you look at the IGV, so we talked about Salesforce and we talked about Adobe. Salesforce is number 4 in the IGV. Adobe is number 8. The biggest positions are Palantir, Oracle, and Microsoft. So you're not necessarily buying just the companies that you talked about with issues. I do think that there's opportunity for investors to average into software. I'm not saying that it's not going to go down further before it goes back up, but I did use IGV as my final trade on halftime a couple weeks ago.
Okay. And the one thing I'd say, and I agree with everything you said about the fundamentals and the opportunity, is really that application layer where you're going to start to see some of these software companies that create these agents and they start getting uptake on it. I mean, that's where these companies are expected to get some sort of return on their investment, and not just internally. And this is what Salesforce told you, that they are getting productivity gains from agent force within their own company. They're just not seeing a huge uptake outside of it. So that will be the narrative eventually. Maybe you have some support, you get back towards that 200-day moving average. You know, Microsoft's a real problem in my opinion. Let's just pull up Microsoft for a second. Stock has barely seen an uptick since that opening gap print after earnings. You can see that right there. Let's go to Oracle. So that's down about 10%. Oracle is not too different. If you see that, let's go to Palantir. So these three stocks make up 28% of the IGV right now. You know, even Palantir hasn't made a lot of progress since its earnings. So maybe it's just digestion, you know, that sort of thing. All right, let's talk about the IPOs because I think this is really important. You know, just as the S&P a week and a half ago was making all-time highs, or 3 days ago, whatever the hell it was, you know, this narrative about, there's two things about how healthy it is right now for these tech companies to finally come public. Okay, that we know that the IPO window has been shut for a couple of years, but we're also seeing this competing narrative that private tech companies can raise as much money as they need, right? Whether it's equity, whether it's debt, they don't want to go public. They don't need the public markets, that sort of thing. So let's just look at some of the biggest issues that we've had this year. If the guys can pull it up here, CoreWeave. Okay, now this is one we don't have to talk about the fundamentals or this and whatever. Let's just look at what happened since its IPO and look and see where it is right now. So it traded at 185. Right now it's at 85. Okay, and you saw that IPO, I think, was $38. Now let's go to Circle, CRCL. That's what it comes out. This one, obviously, this is in the crypto space. You know, it had that post deal move, and look at how it's just ground lower. Let's look at Bullish. This was recent, BLSH. This is also a crypto exchange. Okay, let's look at Chime. I think it's CHYM. This is a neobank that went public. These things all act like shit. Am I missing any? I mean, they still have
Figment. Throw Figment in there.
That's where I was going. All right, so Guy, give me
I'm in your head right now.
I know. Yeah, this is how I started thinking about it, and I just missed the one that was like the inspiration. So talk to me, Guy, about what's going on here.
Well, you know, we said last night. So at its zenith, that's a great word, by the way, and you know, Dan probably has it in front of him as well. But when this was $120 stock, this was probably a 60, maybe less than $60 billion market cap company. You say, well, why is that interesting? Well, because they're going to do about $1.5 billion in revenue, maybe. Mm-hmm. It's also a company that at its zenith was probably trading, I don't know, close to 300 times next year's EPS, which, again, if you're growing, that's one thing, but EPS has been flatlining now for quite some time. I think year over year, you're going to have sort of flat to maybe negative EPS growth. So that's a problem. And what I said last night on the show was, I'm surprised it's not down more. So I think today it's down, down 17% or something like that.
Yeah.
I think yesterday after the close was down maybe 12 or 13. So it's following through. But to your point, whether these things were mispriced or not, it's hard for me to say, but none of them trade particularly well. And I still think there's downside risk to all of them.
All right, Liz. So opine on this. Okay. So I don't really care about a new company, and this is not Palantir that took 17 years to go public, or Stripe that's been around for 15 years that hasn't gone public yet. Okay. Mm-hmm. If the argument is let's let retail participate in the growth of some of these really innovative companies, so go public, then I don't really care much about earnings. Right? Like you basically, it's something that for the moment, right? There are certain metrics that most companies need, 100 million in ARR, like all these sorts of things to go public. Okay. Mm-hmm. But right now, I wouldn't be so concerned with some of these companies that are trying to find their way, and trying to find themselves with a new level of transparency, with a new level of investors, that sort of thing, or recycling of those investors. I don't care much about the earnings. I would care about revenue growth and their ability to kind of grow profitability through margins, that sort of thing. But this company is only growing sales. We're expected to grow sales 20% for the next few years. You know what I mean? So are we focused too much on this small group of names? Because to me, it's a sense of investor appetite. Everybody wants in on the thing that they think is free money. You know what I'm saying? But then as soon as the story just starts to settle down, there's no low enough. And I get it. Let's wake me up when these companies or these stocks are trading near their prior IPO price.
Well, never underestimate the power of hype on an IPO too. And there's a lot of hype, and then there's the scarcity, whether it's an illusion or not, right? There's only a certain number of shares available, and then there's all this hype around it going public at a certain price, and then there's this supply demand dynamic, and it's exciting, and then sort of the reality sets in. And to your point about earnings, depending on where a company is in its life cycle when it goes public, and now companies are going public later in their life cycle than they used to, but oftentimes it's still early in their grand life cycle. So you shouldn't maybe expect earnings out of a company right then, because that's not really what you're buying it for. You're buying it for their growth. That company should be reinvesting the profits that they can make into their own growth. So the earnings may not be there for a while. They have to take time to materialize. As far as buying it because, having people have appetite for it. I would also argue, I don't know that companies necessarily need to go public in order to be there for the retail investor. There's a lot of democratization going on in private markets right now. You can still get access to a lot of those companies before they go public, and the ones that don't even want to go public, right? So it is a different ball game. I think that the IPO market now, it's gotten a lot of press over the last few months. It's heating back up. It's this big thing. Well, it's really nowhere near where it was at some of the heights. So it's not a signal yet, but it is, I think, a signal of risk appetite. It is a signal that people are still optimistic, and the prices coming in so hot in the beginning and then falling back down, I think, is just an indication of a little bit of complacency.
When I was in school, Betty Grable was a pinup model, and a lot of the guys, my buddies, had like a Betty Grable poster above their bunk bed. I didn't. I had posters of like bond yields and credit spreads and 210s. And when I saw Elizabeth's note today, I'm like, oh, OMG, she's so in my head. So if you go to SoFi.com, # all those things.
SoFi.com/on-the-money.
Grace to be the one to say it.
I love it. It's so much fun. Yeah.
But let's go through this because you're talking. I feel like you were speaking to an audience of one, and that person would be Swizz. But please.
Yeah. So the title of this note, this is on the bond market, the great and powerful bond market, not the great and powerful Oz, but the great and powerful bond market, titled Borrowed Time, which I found quite clever of me, if I do say so myself. So opening this note with a quote from a news article that I read yesterday. Treasury yields advanced on Wednesday, with those on benchmark 30-year debt approaching within a whisker of the closely watched 5% level. We're back down to 490 today. Yields on UK 30-year bonds increased to 5.75, already the highest since 1998, while Japan's 20-year notes climbed to the highest this century. Now, that's maybe not saying a lot because Japan's notes and bonds have been the lowest this century, perhaps BC. But anyway, Japan is in a different league. However, the point here being global bond yields, particularly long-term global bond yields, on the rise across the board. And if you even take an index of 10 plus year global bond yields, you'll see how big that rise has been, which is what we're looking at here. Why do we care? There could be a couple different reasons why we might care about this. First and foremost, the most cited reason that global bond yields are rising on the long end is that many investors are concerned about the level of government borrowing that's going on, the level of fiscal spending that's going on, and perhaps the lack of fiscal discipline. So the question becomes, where's the money going to come from over the long term? Maybe we're not worried about it today, tomorrow, next week, but we're worried about it over the long term. So investors are demanding higher yields to own longer term bonds. Now, the other thing that you've got baked into that is perhaps rising inflation expectations around the globe as well. Long-term yields are more tied to inflation expectations. Short-term yields are more tied to monetary policy today and the near-term monetary policy moves. So we're seeing this steepening of the curve around the globe. It's happening at the same time as pressure on a lot of those AI-centric, AI-adjacent stocks, which we consider long-duration stocks. So this is a relationship that is intact. As long-term yields rise, long-duration stocks fall. That is happening as it should. The concern here is that since those are the stocks holding up basically the entire stock market, if long-term yields continue to rise and pressure them, where do we go from here in the stock market? So I think this is something to watch. It's not necessarily just a done deal that this is a bad signal. You could also argue, if you want to be bullish, you could also argue that rising long-term yields and steepening yield curves are actually an indication of rising growth expectations around the globe and healthy economies. I think still to be seen what the real answer might be. I think we all know where Guy falls on this, but still a question mark of what it ends up being.
Yeah, the consensus is not in that camp, right? And if you think about it, and Liz, Guy and I talked about this on the Risk Reversal podcast a few days ago. Peter Bookvar and I did too. And we're literally trying to kind of just query some of our smartest friends in the market just to get a sense if we're kind of off base, because I think Guy and I are both in agreement that, longer term rates is more reflective of debts, deficits, inflation expectations. And we agree with the long duration asset sort of situation. I want to pull up an article from the FT this morning. And I think this is really interesting. The guys are going to scroll through this a little bit. So this is putting together what I think are two of the biggest themes in the markets right now. Okay. So, we had this crazy situation, obviously, in April with the rollout of the tariffs. Okay. We were in the camp. Why would they go and start a trade war first with our allies? Get that spending bill done, or that tax bill. And I'm not saying I wasn't in favor of that bill, like no way, shape, or form. And you guys don't care what I feel about that. But I'm just saying we knew that there was going to be huge cuts to social safety net, huge tax cuts for corporates and very wealthy people, and still a lot of spending that was front end loaded, right? So like that was the deal. I would have done that before launching a trade war if that was my prerogatives one way or another. But it's interesting that we had that volatility in almost every major risk asset, right, in the first half of April, and they didn't like the tariffs. And all those expectations that it was going to be, cause a recession here, a global recession, or at least a slowdown, that sort of thing. And now what this article is talking about, that bond investors, they're saying now, wait a minute. With those tariffs being struck down or meant to be illegal by that appeals court, if you lose that revenue that the White House is saying is $4 trillion over the next 10 years, look at that. And that's meant to offset the $4 trillion of deficit spending or debt that's going to be added to our debt load over the next 10 years, then we got a problem. And to your point, long-term yields should go higher. So, Guy, thoughts on that? And then we'll have...
If we lose the old man, we lose our political power. It's easy for you to say it's not your father. He's just as much a son to him as you and Mike. Notice he left Fredo out of that. But
that was hold on. It was Tom Hagen who said that, right?
Well, Tom, and that's exactly right. Look at you. But Tom Hagen didn't mention that Fredo was anyway. Yeah. I mentioned that because if you lose this revenue, you have a problem. Now, let me try to make an analogy here. It's not when people have, God forbid, leukemia or something like that. Typically, it's not the leukemia that kills you. It's the treatment. So why do I go that? So go back up to the other thing. What we have a problem. This country, in terms of the debt problem, we have a leukemia problem. And we've decided that we are going to do probably the last ditch effort in terms of treatment. There's a good chance the treatment kills you, but there's a slight chance that it works. And in this case, the treatment are these tariffs. Now, if it works, they pulled a genie out of the bottle. But if it doesn't work, it's going to kill the patient. So what's my point? Like, they're going down a dangerous road here because I think they believe that tariffs are not going to be at all disruptive to the economy, margins, markets, bond, all those different things. And if they're right, then you know what? They've maybe gotten themselves out of this debt problem. But there's the Lions, the high percentage play is they're not going to get this one right. And, the problem that we have in terms of debt to GDP is just going to continue on its merry way. But that's the bet they're making. And right now, for whatever reason, the market seems to be giving them some clearance. I'm not sure how long that's going to last, Dan.
So the timeline of how this happened, it was announced after the market on Friday that the tariffs were illegal. And then the fear over the weekend was we're going to have to give all the money back. That's still not been decided. Now it goes to the Supreme Court. I'm way out of my depth in how this all works, right? From what I understand, even if the Supreme Court strikes it down, there's another way that he can put them through, but then they'd be capped at 50%. In any event, I think at least some tariffs are going to stay on.
Well, it's only the reciprocal ones right now. It's only those 10% and the fentanyl ones, and a lot of these other in copper and steel and autos and everything. They remain, and those are in some of those really critical industries.
Sure. So post-market on Friday, that news comes out. Everybody freaks out over the weekend. Bond yields hit highs. The market in the U.S. opens on Tuesday, and that's when our 30-year debt flirted with 5%. Intraday, I think it did get above 5%, and then closed just below. Then Wednesday, JOLTS data comes in weak, and we go back down to 490. Okay. So the reason I'm laying this timeline out is that the thing that took us to 5% on the 30-year did not get fixed, did not get resolved. The relief that the bond market saw was because of economic weakness. That's not how we want this to work, right? So if long-term yields are rising because we're worried about a government debt problem, and the only way that we can bring them back down is to have bad economic data, we're not headed in a good direction regardless of what happens. So still, although this looks like things are okay now, it was not because of an okay reason.
Yeah, year to date, I mean, the 30 year is 488. you see where the lows, you see the volatility, or you see the kind of bands, the wides here. But, the average has been 4.8%. You know what I mean? So we haven't seen that here just yet. And I do think the reaction to the, and we're seeing it around the world. And I get that. Guy, you mentioned the poster above your bed,
Betty Grable.
A child. I have a
familiar with Betty Grable
question for you. Here's a question. And I know you're a huge Shawshank Redemption fan.
Tremendous.
Okay. So Andy Dufresne, okay, spoiler alert here, people, he gets out at the end, okay? But through the course of decades, right, he is planning, maybe 2 decades or something, he's planning his escape from Shawshank prison.
Mm-hmm.
And he's got this little thing where he's digging a hole somewhere in his room. It takes years and years and years. And they're doing it behind a poster on his wall of a pinup that was not bond yields. And like the stuff that you used to get. Yeah, that was your kink, Guy, back in the day. I mean, we get it. In the mid 70s, that was what you were into. How many different posters over those couple of decades did Andy Dufresne have? And who were the pinups?
So I think there were 3. I think the last one was Raquel Welch, if I'm not mistaken.
Yes.
I want to say Betty Grable might have been one of them, and I don't know, Jane Mansfield maybe, or Marilyn Monroe. I'm guessing.
Marilyn Monroe. So you got 2.
Raquel Welch, Marilyn Monroe, and the first one was Betty Davis, maybe. I'm not sure.
Rita Hayworth.
The great Rita Hayworth
would have been on your wall. There's no doubt about it, because I know that you were just into Rita back in the day. Have you seen
good though? Raquel Welch is a great poll.
A long time ago when it came out.
Yeah, and it probably took you a long time to watch. It's a 4-hour movie.
But
guys, that's good stuff. I mean, like you can't. I mean, this is the way our brains work. By the way,
yeah.
I'm all over the
Mine
Godfather 2 thing, and no, that's Godfather 1 actually. If we lose the old man, okay.
I love Sonny. He's so matter of fact. It's easy for you to say. It's not. I mean, it's James. I'm sorry, Amanda. James Caan. If you go back and sort of read about the history of the Godfather, there was so much James Caan footage that was filmed that they left on, as they say, cutting room floor. And he understood it. He wasn't happy about it, but there was a lot of really good James Caan where character development stuff. But the duration of the movie, they just couldn't put it all in. Back to you.
Well, I wonder if that scene, the little flashback in Godfather 2, Guy, where it's the birthday party and I wonder if that was some of the stuff from 1 in the cutting room floor. I got to hit this one. I think this is really interesting. I was with Peter Bookvar, Danny Moses of the On the Tape podcast, and Dan Greenhouse. It was like an only Dan sort of situation, except for Peter. And a lot of conversations that we were having about the consumer are different sort of business. We were talking about Live Nation. We were talking about a whole host of travel stuff. Affirm kept on coming up, Liz. Affirm. Okay, so this is a company at checkout. You can no, but you guys don't do buy now, pay later. It's not competitive.
We have.
Oh, you do?
Uh-huh.
All right, but let's just talk about the narrative then around this. But look at this stock right here. That gap was on its earnings, and the only reason I'm bringing this up is the notion that more and more, and I know Guy's going to have plenty to say about this. More and more consumers are using this product. Like the better numbers that Affirm have, I don't believe it's better. Like it's saying something like great about the consumer. I'm just curious. Do you see that?
Okay, so what I can say about this is you have to be careful as a company. I'm going to do this in the most benign way that I can. You have to be careful as a company about the quality of the borrower, and certain lower quality borrowers are going to be attracted to a type of borrowing that is going to just run higher risks in the economy. And when you see a certain type of borrowing, which last year during the holiday season, that's when the biggest buy now, pay later started to come out. I just heard a warning yesterday from somebody, I don't remember who, but about this holiday season possibly being the weakest in many, many years.
Yeah, there was some survey that was being touted around.
So last year we had buy now, pay later that came out. Many, many consumers used it. It hit record numbers. You do have to worry about that, because why are so many people doing it? They're doing it because they don't have the money up front. I mean, I remember layaway being a big deal when I was a kid. You can't do that anymore, but layaway was a big deal. And that was something that we followed when you were trying to figure out if people were strapped for cash. So some of these different ways of doing it are just another indication of, is the consumer strapped for cash? But the consumer who's using that is a lower end income, right? And unfortunately, they're not going to show up in a lot of the broader data, at least not until later. It needs to reach up into some of the other income levels. And you don't see that because the higher income levels just make up so much more consumer spending than the lower income levels do. So they're
Scott,
not.
Sorry. I was going to say, Scott, I know you have a question about Apple. We'll get to it. Elizabeth's got a couple more slides that we have to do because credit spreads and 210s. I mean, 210s is something we've talked about, and you made the point many years ago prior to your pregnancy that 210s it's not the inversion that gets you, it's the re-steepening, and here we are.
Yeah, so you can see the 2s, 10s here. We showed the whole inversion. It was a very long period of inversion. The point here being, yesterday it was at about 61 basis points, the spread between 2s and 10s. Point here being is that it's at the highest levels it's been since 2022. And if we all remember, 2022 was not a great year. It was a year that the stock market pulled back quite a bit. It was the year inflation peaked. I'm not saying that this is going to be a huge pullback in the stock market. Obviously, it's already September and we haven't seen that persist. We had one in April, but it certainly did not persist. So I don't think that it's going to result in this huge pullback in the stock market, but I do think that the combination of the spread being the highest it's been since 22 and inflation fears heating back up around the globe, long-term yields going up, there is a relationship there. And this is something to watch. This is part of why you start to get nervous when the re-steepening happens, because what's driving the re-steepening? In this case, it could be inflation fears.
Yeah. And so, this is something Guy said on a podcast, I think with me 2 days ago. And I think it kind of speaks. Let's go to this next slide for a second. It's talking about credit spreads. He said that he thinks we're going to see a VIX above 20. And he said, listen, this is going to be a September to remember. And he almost felt like, I think you said, wake me up when September ends, Guy. And I think that if there's something funky that goes on with credit spreads, you might be right about both of those things.
Yeah,
I said neither, by the way, Elizabeth. I just want to be crystal clear in terms of those glib, but back to you.
I know that I was trying to get all up in his grill a little bit there, but look, Green Day, Green Day, of course. He didn't even flinch on that one.
No.
Love the Green Day.
Didn't
all right, so talk to us about credit spreads here.
This was just basically, if you're trying to be really bearish because long-term yields are rising, you want credit spreads to confirm your suspicion, and so far they have not. Confirm your suspicion if credit spreads blew out. You want to see high yield spreads blow out. You want to see investment grade blow out. It's just not happening, and in fact, they continue to get tighter. So it's not there yet. There's some inconsistencies in the story, which is why you have to leave open the possibility that there's the resurgence in global growth, and that's part of why yields are higher.
Whoa, guys, so you will not have a September to remember.
Maybe that is, by the way, this might be the most important slide because the other things are concerning. But then you look at this, say, wait a second, there's credit markets saying there's no problemo here. Now, we all know that can change very quickly. Credit markets can be fickle as hell, to Elizabeth's point, but right now it doesn't seem to be the case. Anyhow, and I did mention that the steepening yield curve, although people will say is a tailwind for the banks, what I made the point was, Dan, and remembers this, I thought it would be more than offset by the weakness that higher yields are going to have in terms of slowing down growth. So we'll see how that plays out.
Yeah.
Let's put Scott A's question up because he's been clamoring for this one. I have a question for the gang. The gang in this case would be Dan Nathan. Will iPhone 17 sales be the first real indication of AI? Is it monetizable? If AI is monetizable for Apple, Dan?
I can answer this in one word: no. But let's just pull up. There's an interesting story. I think it was in the Journal today or yesterday. Well, no, let's go to the one about Perplex or the AI search. Okay, we'll get to that one in a second. So this is the headline 3 days before they're going to announce the iPhone 17. Do you guys have this this one about AI powered search? There you go. Also Bloomberg. Sorry. So we know that AI or Apple Intelligence June 2024 did not materialize. We know that they've lost a lot of talent. They pushed out a lot of plans. OpenAI and Perplexity have been gaining a lot of steam. OpenAI predominantly, Google Gemini, it's been a thing that's across all their platforms. So Apple here, there was rumors they were going to maybe buy Perplexity. there's nothing going on here. I mean, like, this is actually an embarrassment that they are basically talking about this search product integrated with Siri, even if they're using OpenAI technology or Anthropic or anything like that, to wait another year as all of these guys, OpenAI in particular, are just gaining market share. Like to me, this is embarrassing. Okay. And they're not going to be able to do what Meta did, hiring all this talent away from OpenAI. They spent hundreds of millions of dollars. Not that they couldn't do it financially, but it's not in their DNA to do so. And you could say, well, Dan, this company has never been first to these sorts of things, but they always, they'll do it better. They have massive distribution. We'll see. This time it might be a little bit of a wrinkle. And then the other story really quickly, China is this huge market for them. There's a lot of estimates that there's 300 million iPhones in China, many of which need to be upgraded. But we know what's going on here. There's a lot of nationalistic tendencies. Companies like Huawei are making a lot of progress on the hardware. Look at that. Hold on. Let's go back to that.
Oh, that's a bang.
3 folds. Apple doesn't even have a fold.
Wow.
Samsung's got 2 folds. They got 3 folds. I mean, like, listen, I'm not telling you that there's gazillions of people who want 3 folds, but we're talking about China out innovating on the hardware front. And you can actually draw the through line to what they're doing in EVs. And, Huawei is a company that has an EV in China. You know what I mean? So again, I think at least for the next year, Apple is dead money. And I'll just tell you, it's been dead money for the last few years. So to me, this is not a growth company. They're not innovating, and it's just not interesting to me, Guy.
Real quick, Jack CF's question dovetails. Will Apple announce the partnership with Google next year? They've had a partnership with Google, I thought. And no?
Am I missing something? Gemini. I think they mean
for the Gemini. For the Gemini.
Yeah. I think that they'd want to be a little bit careful too. They just had this remedy. It was not the worst case scenario, obviously, for that search, the exclusivity on search on iOS through Safari. But if they go do some huge deal, you know what I mean? Like, this is the other way, by the way, is like Apple would actually need to pay Google, but it just furthers their dominance and potentially in search, that sort of thing. So again,
it was the removal of an overhang. It wasn't some kind of new announcement.
I just didn't think it was worth 9% yesterday, and I just didn't think the overhang was like a high probability event. You know what I mean? So anything else, Liz, anything else on your mind before we get out of here?
I mean, just the jobs data tomorrow, frankly. That's what I'm
watching. So we're gonna have the final countdown. Guy, what time does the
all important jobs number come out? 8:30, I believe. 8:30. Elizabeth does that. She's like in the Octabox.
I'm not in the Octabox. 8:30 Eastern time tomorrow. Right now, probability of Fed cut is 98.9% in September.
Near certainty.
We'll see. That could change.
All right. So let me ask you this: how bad does the number have to be for 50 to kind of start rearing its head here a little bit?
I would say it has to be below 35,000.
Really, Guy? What do you think?
I think she's right. Anything below 50, I think people can get a little. I think the number's 50, but 35 is fine as well. The unemployment rate,
because that's the average, the 3-month average.
Is that right? The 4.3 unemployment rate, which I think it's going to be, rigged, not rigged.
Here's another number. Quick question. Okay, so we got this new BLS guy in there, right? As far as the response to the surveys, they're not going to change in a few weeks, you know what I mean, a matter of weeks or whatever. Does the White House almost say, fine, let it rip, let it be 20,000, you know what I mean? Because then they will literally go ballistic, like trying to get a 50 basis point cut, which, by the way, last September, we had a 50 basis point cut right out of the gate, which was the first cut since 2020. You know what I mean? So, like, does maybe the weakness give the White House what it wants, although it basically can still blame the BLS bullshit on the last part.
But then it's a black eye in terms of the job growth during administration. Like you can't have it. You can't have it all ways. It's sort of one or the other. Real quick before we get out of here, because I want to try to get to Zlad's question about Amazon. Look, I mean, Amazon is what it is. I think we all understand. We're right up against the levels that we saw in January of this year, which I believe was an all-time high. I think that price, Dan, was like 242 or something. So here we are. You can see the double bottoms, 167 in August of last year, 167 again in April of this year. So you traded against those double bottoms. The question is, do you trade against these double tops? I think you do. I'd be taking profits here in Amazon. Dan.
Yeah, I mean, listen, bounced right where it needed to, 2 times now. If you think about it, the gap up, on that earnings back there, the Q1 earnings, and then had that gap down on, Q2 earnings. And here it is. It's kind of, making a little bit of a flag. I mean, again, AWS is really the story here, but one thing, they have this partnership with a firm, the buy now, pay later. And so if you think about, might that kind of increase their retail sales in the near term? And then the other one is that as of October 1st, they just made an announcement. They're basically, how Netflix did away with their password sharing. Amazon's doing away with their Prime, sharing if you're not in the same household. And, listen, there's data that suggests if you have a Prime membership, you are likely to spend, I think, 2 or 3x that of somebody who doesn't have it. So if you can kind of, broaden that membership base out and then get increased leverage on the spending, you know what I mean? That could be a good thing for them. So again, who knows? All right, Guy.
Hold on. Before we go, I'm sorry.
Yeah.
Elizabeth, for you, the Packers of Green Bay, the now Micah Parsons Packers of Green Bay, play the Lions of Detroit. Everybody's All-America, everybody's favorite. First week of the season.
Yeah.
Thoughts?
Yeah, that's going to be a tough opener.
Thank you for that. I appreciate that.
I am pro Packers. Obviously, if we can get our defense to be as good as our offense, we're in great shape.
Well,
but let's not forget about the Brewers season. It's not over yet. They're still the best team in baseball.
They
so
are.
I don't want to shift gears
Free
too
burgers.
soon. Free burgers are over.
No, you don't. You do not want to shift. Right. Your attention should be focused firmly in the camp of the Milwaukee Brewers. You are correct.
It is.
All right, Liz Young, you're going to be.
No, it's Elizabeth Thomas.
It's going to happen.
No, it hasn't happened with me.
LT. Lieutenant Liz. LT, you're going to be with Guy on the Risk Reversal podcast. That's going to drop on Monday. And you guys well, no, it's going to be a post all important August jobs report podcast, and that'll be in the podcast store on Monday morning.
Mm-hmm.
All right.
When Elizabeth and I are left to our own devices,
watch out. Yeah.
All right, Liz, thanks for being here.
Thank you for having me.
All right. See you. Bye, everyone.